Hello learners, I welcome you to our second lesson in our discussion of the statements of financial statements of a limited company. Financial statements of a company. We are studying the financial statements of a company. Financial statements of a company. And today we will start by identifying these statements. One important statement is the income statement. The second one is the statement of financial position. Statement of financial position. These are the main statements that a company is expected to prepare. Financial statement. We start by discussing the income statement, also known as the trading profit and loss account. The income statement, and we start by saying that the income statement of a company is prepared the same way you would prepare the income statement of a sole trader. The only difference being that there are additional expenses which are unique to a company. Different expenses that are unique to a company, and these expenses should be included in the income statement. These are additional expenses that are unique to the company and should be included in the financial statements or the income statement. For example, number one, the director's fees, salaries, and other expenses. Number two, audit fees. 3, amortization of goodwill. 4, debenture interest. Debenture interest. So these are the expenses, and remember we mentioned some of these expenses like the debenture interest. We say that debenture interest is paid to debenture holders because debentures are long-term loan capital. Okay, those who provide long-term capital to a company are paid debenture interest, which is unique to a company, and it is treated as an expense debited to the profit and loss account. Now, in addition to the income statement, just like a partnership has an appropriation account which shows the allocation of the net profit for the period. In addition to the income statement, there is an appropriation account, just like in the case of a partnership. There is an additional appropriation account. After determining the net profit, a company is expected to prepare an appropriation, a profit and loss appropriation account, which shows how the profits that are generated within a given financial period are distributed amongst different parties or apportioned or set aside to reserves. So the appropriation items for a company would include allocation to reserves. It would also include the payment of dividends, the preference dividend, the ordinary dividend, and so on. So the two accounts, starting with the income statement, we can start by considering the format of an income statement for a company. So we'll start by having, say, 3 columns there. 3 columns. And remember, we say that an income statement prepared by a company is prepared the same way you would prepare the income statement for a sole trader. For example, any business would have sales or turnover. So we'll have our turnover there. Then we can deduct the returns inwards to arrive at the net sales. That would give us the net sales. Then out of the net sales, if we are to deduct the cost of sales, which is equal to the opening stock plus purchases minus closing stock, then deducting cost of sales from net sales, we have the gross profit down there. The gross profit. Then you can have the expenses. You have the normal expenses, but when you are talking about the expenses for a company, remember we have mentioned expenses like directors' fees, the audit fees, directors' fees, audit fees, debenture interest. We mentioned debenture interest, the debenture interest. Then we also mentioned goodwill amortization of goodwill, and the other expenses which I know you are aware, you know these expenses. So all these deduct from the gross profit to arrive at the net profit. Okay, so this net profit is prepared the same way we prepare is arrived at by preparing the trading profit and loss account. The same way we would prepare that one of a partnership or a sole proprietor. So from that profit, we now do what we call appropriation. And before appropriating, because this is net profit before tax, net profit before tax, the net profit before tax. Then because companies are expected by law to pay corporation tax, as we discussed in our last lesson. For example, in Kenya, the corporation tax rate is 30%. 30%. So corporation tax should be deducted. Corporation tax at 30%. 30% of that will give us the taxation, corporation tax, which should be deducted from that profit before tax to arrive at profit after tax. Profit after tax. It is now this profit that will be the subject of appropriation, because remember, an addition account is we need to prepare an additional account which you are calling the profit, continuation of that, profit and loss appropriation account. Profit and loss appropriation account. So what is being appropriated here is the profit after tax. The profit after tax is what will be subject of appropriation. So out of this profit, a company is expected to pay preference dividend. Preference dividend, and this dividend may be interim dividend plus the final dividend or the proposed dividend. So this dividend should be deducted from the profit. So that is the preference dividend. Remember, we say that the dividend has to be deducted from the profit, whether the dividend has been paid or not. Whether the dividend has been paid or not. Then we can also have another appropriation item, which is transfer to general reserve. The company may decide to transfer some portion of money to the general reserve, or any other reserve. It can be the fixed asset replacement reserve or any other reserve. So what remains here should be paid depending on the dividend policy of an organization. Then this amount here can be distributed, all of it, in form of dividends. That is the ordinary dividend. The directors can decide to pay all the profit to the owners in form of dividends. That is 100% payout ratio, or a portion can be paid. So we can have here the interim dividend, add the proposed dividend or the final dividend. So this total dividend should be deducted from, if the total dividend is not subject to 100% payout ratio, then we'll have a balance there, which we are calling the retained earnings. Retained earnings. Remember, we say that this is also the profit and loss account. Carry down can also be referred to as undistributed profits. The undistributed profit. So that is a general format of an income statement for a company. The general format. That is how to prepare the income statement for a limited company. So this is the way to do it. So we will proceed and look at the statement of financial position, which is also known as the balance sheet. The balance sheet of a company. That is the statement of financial position. Statement of financial position. Now the balance sheet again is prepared in the same way. You would prepare the balance sheet of a sole trader or a partnership. So we'll have our columns. So normally, remember, the balance sheet is prepared on the basis of the accounting equation or the balance sheet equation, which states that assets equal liabilities plus capital. So a balance sheet is, or a statement of financial position, is simply a record of the assets and liabilities and capital of an organization. It is a record. It is a statement that shows the assets, liabilities, and capital. So first, we can have the non-current assets. The non-current assets like land, motor vehicles, okay, land, motor vehicles, total. Then the non-current assets, debtors, bank or inventory, have the total there, and the total assets. Then there is this is assets. Then you can have the liabilities. Like creditors. You can have liabilities like proposed dividends. You can have debenture interest due. Okay, debenture interest due. So we have the liabilities. Then we add the capital. Now the capital will comprise the ordinary share capital, the share premium, we add general reserves, the general reserve or any other reserve like the capital redemption reserve, the revenues reserve, and so on. Then there is also the retained earnings or profit. Retained earnings or profit. So this is the total capital or shareholders' funds. This is referred to shareholders' funds. Remember, shareholders' funds will be equal to the ordinary share capital plus reserves and retained earnings, including share premium. So this should give us the total capital and liabilities. Total capital and liabilities. So this is a general format for a statement of financial position of a company. It is prepared the same way you would prepare the financial statement of a sole trader, but there are some unique items or entries which are made in the statement of financial position of a company, like the ordinary share capital. It's unique to a company. Share premium is unique to a company. General reserves are unique to a company. Debenture interest due, unique to a company. Proposed dividends, unique to a company. Otherwise, the rest of the items are the same. Assets are treated the same way. Non-current assets, the current assets are treated the same way. These are current assets. So the statement of financial position and the statement of the income statement, this is how you prepare the income statement and the statement of financial position. It's a general format. In our next lesson, we'll consider an illustration. We take an illustration and solve it. So thank you for attending this lesson. We will look at an illustration in the preparation of the financial statements of a company. Thank you and God bless you.